Hello and welcome to our new series, Capitalise. Where we'll travel across India and the world to unravel some of the most interesting finance stories. I'm your host Vidhan, and today we are diving into the fascinating world of crude oil derivatives. Did you know crude oil is the most actively traded commodity in the relevant exchange? The combined value of crude oil across all contracts averages over 3,000 crores daily, translating to roughly 8,500 barrels traded each day. Market participation comes from both corporate giants like ONDC and Reliance and individual retail investors like you and me. While institutional orders primarily hedge exposure in the spot or physical market, retail traders speculate on the price movements. Now, before we dive into the intricacies, let's start with the basics. Crude oil, as you know, is a naturally occurring fossil fuel that is extracted from the Earth's crust. It is the lifeblood of many industries around the world, as it is used to produce gasoline, diesel, and other petroleum products that power our daily lives. And in case you didn't already know, India is one of the largest importers of crude oil in the world. Our country imports over 80% of its crude oil requirements. This makes us heavily dependent on global markets. In fact, even a minor fluctuation in the crude oil prices can have a significant impact on the Indian economy, affecting everything right from the cost of travel to even the cost of vegetables. To mitigate these risks, crude oil derivatives were introduced in India. Now, crude oil derivatives are financial instruments that allow investors to speculate on the future price movements of crude oil without actually owning the physical commodity. Crude oil derivatives provide a way for traders to hedge their positions against market volatility and protect themselves from potential losses. One example of the crude oil derivatives is the Brent Crude Oil Futures contract. Now, Brent crude oil is a benchmark grade of crude oil that is widely used in Europe and Asia. The Brent Crude Oil Futures contract allows traders to trade in the commodity by agreeing to buy or sell a specified amount of Brent crude oil at a predetermined price and date in the future. Another example of a crude oil derivatives in India is the Crude Oil Options contract. The Crude Oil Options contract gives the buyers the right but not the obligation to buy or sell a specified amount of crude oil at a predetermined price and date in the future. Now, this provides flexibility for investors who may not want to commit to buying or selling the commodity outright. The National Stock Exchange offers various types of crude oil derivatives, including futures, options, and swaps, providing investors with efficient trading tools. Now guys, if that's clear to you, let's move on to the next part. Why are crude oil derivatives so popular? The first point is low margin requirement. The entry barrier for trading crude oil derivatives is relatively low. Second, global price linkage. While crude oil rates linked worldwide, manipulation is difficult. Third, portfolio diversification. Crude oil derivatives offer a way to diversify your portfolios without physical shortage or transportation. It also acts as a natural hedge against inflation and currency fluctuations. Fourth, economic importance. Crude oil is crucial to our economy. And fifth, high liquidity. Investors can easily buy and sell derivatives at almost any time. In recent years, there has been a shift towards renewable energy sources in India, which could potentially impact the demand for crude oil and its derivatives. However, experts predict that crude oil will continue to play a crucial role in the Indian economy for the foreseeable future. The current trend suggests that the demand for crude oil derivatives will remain strong, with more investors looking to capitalize on the opportunities presented by this market. Take this example. During the COVID-19 pandemic, the demand for crude oil dropped significantly due to reduced economic activity and travel restrictions. This led to a sharp decline in crude oil prices. However, savvy investors who had invested in crude oil derivatives were able to profit from the market downturn by shorting the commodity. As we talk about crude oil derivatives, it's also key to acknowledge the darker realities of financial markets. The vulnerabilities and risks associated with speculative trading are very evident. Now, did you know that in India, 90% of individual traders incur net losses? So if you're navigating these markets, do them extremely cautiously. And if you're seeking guidance, don't forget to follow Phillipcapital on Instagram and hit that subscribe button and the bell icon below so that you never miss an important financial insight. So bhaiyo aur behno, thank you for joining us today on this extended story on Capitalise. Remember, always stay informed, stay passionate, and stay financially savvy. I am Vidhan signing off for Phillipcapital. See you in the next episode.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.